All right, today was another wild day in the market. Leopold Aschenbrenner's fund imploded allegedly. So definitely had to jump on here and just kind of share and get my thoughts on it. So first, I want to talk about who Leopold Aschenbrenner is, what is situational awareness, and then what happened today, and then what are some of the takeaways and what can we learn from it, even if you're not managing a fund of that size and you're just trading your own portfolio. I think there's a lot of takeaways that can kind of come out of this. So first of all, who is Leopold Aschenbrenner? He is a former OpenAI super alignment researcher, and he came out with this paper back in 2024 called Situational Awareness. I read it. It's actually really good. He outlined basically a roadmap for how we'll get to AGI and advanced intelligence. And obviously, he was in the right place at the right time. Super smart kid, and was working at OpenAI, and so he had a lot of insight into what was happening, and specifically around scaling laws and how that would create these bottlenecks in terms of infrastructure around AI. And so he didn't just release his paper; he actually put some money behind it, and he went and raised a fund called Situational Awareness to basically implement this thesis and invest into these AI infrastructure names. So he went long, everything from power to data centers, memory, GPUs, you name it, anything kind of behind the AI infrastructure trade. He went heavily invested in that. He also put on some shorts in software and some other names, Adobe and companies like that could be negatively impacted by AI. But his fund was highly concentrated in the AI infrastructure trade, whereas a lot of funds invest in a number of different areas, or you always hear people talk about how important diversification is. His portfolio was not diversified at all. It was all the AI trade, and that worked out really well until it didn't. Allegedly, he raised like $200 million and turned it into $20 billion. Everyone was calling him the next Warren Buffett. He seemed like a genius, and he was definitely right, and he made a ton of money in the process, especially in a very short amount of time. But as we saw today, it's all about risk reward, and he definitely had a lot of risk on the table. And so what happened? So today it came out that he had to basically unwind his portfolio and sell it to, it just came out, it was Citadel who actually bought his public equity portfolio. And if you've been watching the markets over the last few weeks, or definitely the last few days, there's been a massive sell-off around AI. SK Hynix released their public report, and their stock sold off. The Max 7 has been selling off because people think they're spending too much in CapEx, which doesn't really make sense, because at the same time, the companies that are benefiting from the CapEx have also been getting hit in the last couple of days. But really, overall, the whole market has just been selling off, specifically in tech. Yesterday, we just got the Fed interest rate decision, and they decided to hold steady. But actually, Citadel, and I don't know if this is a conspiracy or if this was intentional or not, but Citadel actually came out before the FOMC decision, and they were the only bank on Wall Street that said that the Fed might raise interest rates. And I think that actually helped spook the market as well, and just helped accelerate the sell-off, because if the Fed starts raising rates, that negatively impacts high beta names and tech specifically. So I don't know if they did that intentionally to try to create this situation, but it was just a bunch of headwinds that ended up negatively impacting the situational awareness portfolio. And again, because they were so heavily concentrated in these names, they got impacted the most by this sell-off. So as I mentioned, the long positions all started to fall. They were heavily invested in memory and names like SK Hynix or Nebius, NeoClouds, and all of those names have been selling off aggressively, down maybe 30-40% from the highs. So that all put pressure on the portfolio. And then to counteract that, or to make it even worse, the short positions in software have been rallying. So I'm not sure exactly why, but as the AI infrastructure names have been moving up, software moves down, and vice versa. So if software is moving up, typically the AI infrastructure names have been moving down. And so he basically got cut twice. And then apparently he was leveraged at like 4x on his positions. And so when you get that drawdown, even a 25, 30% drawdown, if it's your own money, then maybe you can just hold and wait until, it bounces back. But, when you have margin and, you get margin called, then now you're forced to sell at the bottom, or you have to offload your portfolio and have someone like Citadel come in and try to save the situation. To make matters even worse, apparently they have a position in Anthropic. I think that's worth about $5 billion or something like that. And so to add some liquidity for the public market portfolio or for the margin call, they had to also potentially sell some of the Anthropic position. That's been rumored. I don't know if that's been confirmed. But, obviously Anthropic is planning to go public later this year. So that would really suck if they have to sell some of that portfolio or some of that position before the Anthropic IPO. That would obviously be leaving a lot of money on the table. But, what are the takeaways here? I think the memes have been crazy. If you go on X, everybody's kind of piling on right now. But I like to think about, what are the takeaways for, me or you, or if you have a smaller portfolio, even if you're not managing a hedge fund like this. I think for me, one, you have to manage risk. And when you hear professional, traders or investors talk about investing, it's always about risk reward and managing risk. And, obviously with his portfolio was heavily concentrated into one sector. And so if that sector pulls back, then now you're heavily impacted. Second, obviously, respect liquidity. I think Charlie Munger had a quote that was like something like 3 things that destroy men, women, alcohol, and leverage. And, obviously he took on a lot of leverage and it worked out great until it didn't. And then obviously, even though he was up like 1,000% or something like that, he wasn't able to weather the storm and weather a pullback, and ended up having to get margin called. And then the last is, a lot of people are comparing him to, the next, kind of Warren Buffett. But I think what really distinguishes Warren Buffett and makes him so, spectacular as an investor is that he didn't just have one good quarter or one good year. A lot of people have a good quarter or a good year, but Warren Buffett was able to just compound over decades and just consistently produce returns, be very patient, and, buy low, be willing to just sit in cash, not chasing the quick dollar. And, that type of durability is really rare. But I think ultimately that's what you want to avoid situations like this. Now, I don't think we have to feel too sorry for, poor Leo. I mean, he's only, like in his early 20s, maybe 25. I'm sure he's made hundreds of millions of dollars just in terms of fees. Maybe he's even still a billionaire from all of this. So I think he'll be fine. I think, a lot of us wish we could have anywhere near that kind of return or portfolio. And hopefully he did take some profit. I think that was, I don't know, at least something I was wondering is, I mean, if you're up, 20 billion, 10 billion, 1 billion, it seems like you should take some chips off the table, lock in some profit. But I don't know, maybe he did. Maybe we just don't know about it. Maybe he saw the bigger picture and was like, I want to be in this for the long game. This could run a lot further. There's still a lot of demand, and the demand still outweighs the supply. So maybe this trade is just getting started, and we can go on forever. But who knows? I guess we may never know the answer to that. But definitely a crazy story, crazy situation. I'm going to keep watching this and curious to see what happens with the rest of his portfolio, and see if he'll bounce back. Maybe he'll start a new fund and come back a little different this time. But I think this shows you that the Wall Street, the professionals, I mean, these guys are sharks. When they smell blood in the water, they see someone who's levered up and just overexposed, I think that's they see that as an opportunity, and whether it's market manipulation or whatever it may be, too big to fail. Who knows? They're gonna jump on the opportunity and take advantage of it when they can. So crazy story. Definitely keep an eye on this, and be back for the next one.